Today, we're going to share the three golden rules every real estate investment should follow to ensure long term success, stability, and strong returns. Real estate investing can be highly rewarding, but the problem is too many investors take unnecessary risks that leave them exposed. Rising interest rates, unexpected expenses, and deals that rely on future appreciation can put portfolios in jeopardy. Today, we're going to be breaking down these rules and why every investor should follow them. John, great to be here with you.
Yeah, Mark, glad to be here as well and excited to talk about this topic. I think that, having rules for how you conduct your business and how you conduct your life is one of those things a lot of people miss. And, when we first started Faris Capital Partners, it was really one of the first things we talked about. Like, what are our standards going to be and what are the things we're going to do to ensure we minimize risk for our investors and, deliver exceptional returns. So excited to dive into this topic today.
Yeah, for sure. And, especially with what happened over the last couple of years, where we saw interest rates pretty much double and we saw a lot of operators get into some big trouble. The reality is if the operators would have followed these golden rules that we're about to share, they would have been fine. And when you look back in history, if you go through any cycle, these three golden rules were, we'll just say, the reason why they're golden is because they're gold when you go into a downturn in the market. And so what's interesting, John, is that real estate goes in cycles, and we know there's an up and there's a down. And so the reality is when it's up, it's easy to, we'll say, get lax on your rules. It's easy to, take a little bit extra risk because, real estate at that time feels like it's always going to go up. There's so much demand. But you and I, we've been in the business long enough where we've seen how a market can be like super hot. We're bidding wars, like, $200,000-$300,000 over asking. And all of a sudden it turns on a dime. And
Yeah.
so because of our experience, we've seen this. And so the golden rules just make it simple enough to follow and at the same time to be able to ensure that you just don't get into a pinch when you least expect it. Because these things you never expect, downturns in markets, right?
Well, that's right. And, post pandemic, if you look back into like, say, April, May of 2020, I don't think anybody would have predicted what happened in 21 and even the first, quarter of 22 and even into the second quarter, just because of the nature of contracts and how long it takes to close. But we saw the market get so overheated for these multifamily assets. And, at Ferris Capital Partners, we actually view ourselves as lucky, starting our business in a more challenging market because it forces you to get disciplined and to get focused and to follow these three golden rules that we're about to outline. And you can look back and you can see the mistakes that other operators made and learn from those mistakes. And so, number one, the number one first golden rule is what a lot of operators are suffering for because they did not follow it. And that is to always secure fixed rate debt. Or if you're using floating rate debt, which there are some cases that it makes sense, make sure you have a cap rate. And if the operators had followed that rule, many of them would not be in the challenging situation they find themselves in today.
Yeah, yeah. These rate caps, they essentially what they are is they prevent if rates go up by double, it locks in a rate at once it goes past a certain amount. And so you basically pay insurance for that. And so I was actually on a call with another operator. And on the call, it was very they were on with their mortgage broker and they were talking through and they were actually this is at the peak of the market. I recall the conversation is like, rate caps, they're just not a good investment. Like, insurance companies, they know what the risks are. And if it was going to go up, it's just not a good investment. And so, and what it does is like insurance. And so insurance it makes a lot of sense. If your building gets burned down, you have insurance to protect you in those one-off scenarios that are very unlikely. But what will get you out of the business faster than anything is by leaving exposure to, these events that come up once in a while. And so you want to be able to continue to play the game long term, right? And
Mhm.
if you get smoked the one time, it can completely knock you out. So it makes sense to have insurance. And the same is true when you are locking in your rate. That can actually demolish the deal in a big way if rates were to double. And now, do I think that rates today will double in the future? I don't think so. But with that being said, I didn't think that rates would double back when, interest rates were half of what they are right now.
Yeah.
And so we always, that's why it's called insurance. You insure yourself for if this happens, and this is no different than regular building insurance. That is really important.
Absolutely. I mean, so there were deals bought in 21 with floating rate debt that worked beautifully. I mean, they were cash flowing, excellent property, rates tripled, and now they're underwater. And if you actually look at those operators that stayed disciplined and got fixed rate debt, even in that time where, you could get much more attractive rates with floating rate debt, those folks are now able to sell with assumable debt. And so, frankly, all the deals we've acquired so far, except for one, came with assumable debt. So it actually ended up being not only an advantage for that operator because their deal was still strong and performed, but now they have a nice selling feature that they can offer. And so we're all about fixed rate debt. That said, there are some times in the market cycle where a floating rate with a cap makes sense. But look at investors who took bridge loans, double, triple rates and just absolutely demolished the deal. So for us, we always lock in that fixed rate when we can. If we're doing floating rate, we always will purchase that rate cap and look at a deal at 6% interest, which is give or take where you can get today. You're a little bit higher, closer to 7% in today's market. If that rate were to go to 9%, you're not cash flowing anymore,
Yeah.
and so it's just we never know what the future could bring. And at Ferris Capital Partners, Mark, you and I are very similar. We're not gamblers, right? Like we are all about mitigating risk and making smart decisions and wise decisions based on the available information. And so for us, the way we execute on that is by protecting our investors with strong financing, but where we can mitigate the risk of rising interest rates.
Yeah, well said. And so for context there, if rates double, when John says that it doesn't cash flow, just imagine that your mortgage payments that you're making every month, just imagine if they double. Say you own a house and you're paying, let's just say $5,000 a month. The reality is if rates double, it's pretty much doubling your mortgage payment. So if you do that on your house, it's one thing. Okay, it sucks. I gotta come up with extra money. But when you're buying, 10, 20, 30, $50 million buildings and those debt payments double, you could see like you can't just dip in your pocket, pull out, the extra amount to be able to float that deal. Like eventually you're gonna eat into your reserves, and eventually the lender is gonna say your debt service coverage ratio is out of whack. We need to call the loan, and that's what's actually happening right now. So by fixing it or by getting a rate cap, the beauty of that is it protects you in those one-off scenarios. And it's like it doesn't seem like that will ever happen. But again, we want to play for the long term, and capital preservation, John, is like that's a big thing for us right here. And so that's where, and same with our investors. We find that, our high net worth investors, their big thing is like, listen, don't lose money. And so Warren Buffett talks about this as well. It's like investing, rule number one, don't lose money. Rule number two, don't forget rule number one.
Yeah, that's right.
Right. And so that it seems so simple, yet it's it takes discipline when the deal can get better by not applying this rule. But
Yeah.
it'll keep you in the long game.
And I think the way I look at it is if the deal only works with floating rate debt, then it's probably not the right deal to pursue anyway. For us, when we pursue a deal, we want to check a lot of boxes, right? In other words, we want to make sure that the deal works under a lot of different scenarios. We stress test every deal, of course, many ways. But even as we're looking at the upside, right, we want to make sure we have a lot of different levers we can pull. And so, if a deal only pencils with exotic financing, then that's a deal we're not going to do anyway, right? Just because obviously it's missing something somewhere else in the deal to make it stand up on its own. So yeah, it is one of those things that we followed from day one and will continue to follow into the future.
Yeah. And so that's another thing is when we're locking in our rates between the time that we acquire the property and we get the initial approval to the time of closing, the rates can actually change. Right. And so the interesting thing there is that when you're doing your underwriting, it's really important to actually underwrite the deal worst case scenario, as in be a little bit, we'll say conservative with what that rate is. And I know John in our last deal it was like, okay, I'm going to lock it in right now, and we did, and thank goodness that we locked it in when we did, because then the rate actually jumped
Yeah, that's right.
after
Yeah.
that, right? And
We
so
locked in, the rates were the treasuries were at 4.3 and change, and we locked in, and then within a month, they were bumping up against 4.8. Now they've settled back down a little bit close to 4.5. But some of that was luck, right? Just in timing. But when the rate came down, our lender, we have great lender partners, called us up and said, guys, I would lock in. And we did.
yeah,
We took his advice, and thank goodness we
yeah,
did. Because candidly, that wouldn't have killed the deal, but it would have had a material impact on the returns for those investors. So,
yeah.
it's sometimes you have to just jump in, right, and make that decision when the rates are looking good. And that knife cuts both directions. Maybe treasuries could have gone down a little bit, but it still was a strong rate, and the deal supported
Yeah.
it. So we just jumped on it.
That's right. And the reality is when we go into it, like in that case there, when the rates, jumped in, the projection numbers were still going to be hit. So now it's going to be that we're going to way overshoot because we got that extra, that lower percentage. And, for us, the goal is that we want to overshoot what our projections are in the deal. And basically we want to save as much as we can in expenses, but we want to generate as much income as possible. And obviously for sure the mortgage that you're getting on the property is a big expense, right? So that's a big part of it.
Number one expense, absolutely. No, got to get that right. Um, Rule number two, for us, we always have reserves. So how we calculate our reserves, Mark, is we always have 6 months of principal and interest payments sitting in reserve. Now, let me give you an example. Often with the financing we're obtaining, for example, our most recent deal, we took down new debt, so it was not an assumption, and we have a period of interest only. And so with that interest only period, we don't calculate the 6 months of interest only payments. We actually look ahead. What will it be when we have principal kick in? And that's the number we utilize. So there's a world that could exist. This deal trades before we even get into principal payments. But we want to be thinking about that because there could be a scenario where we have to hold on to the property a little bit longer than anticipated. So that 6 months of principal interest just sits in a bank account for a rainy day. Big reason we like to do that is because, as we all know, and I think the pandemic was such a great example, you can't always predict what's going to happen. I mean, look at that, right? A new virus kind of comes into the world. World shuts down for a period of time. And so for us, we think about that reserve as preservation of capital for our investors, because ultimately what we don't want to do is have to go back, pause distributions, or do a capital call. So that 6 months is there. But in addition, we do a 10% contingency on our CapEx budget. So we look at our CapEx budget across the 5-year program that we're going to hold the deal, and we net it up by 10%. Now, what we're also doing is we're being conservative with our CapEx projections. So if we're pretty confident we'll deliver a renovated unit at, say, $12,500, we're going to actually budget for 13. Materials costs do fluctuate, right? And so we have to be mindful of that. Sometimes a particular product that we like and we've used in other buildings becomes no longer available, and we have to go back out and source new material. And so that's where that contingency budget comes in. But at the end of the day, cash reserves equals survival in tough times. And so it's something we do on every single one of our deals.
Yeah. Well, and John, we've learned this lesson in business through the years, is that cash is oxygen.
Absolutely.
Yeah. Yeah.
Absolutely.
Oxygen is cash. Cash is oxygen. It's like, man, it's like when you have cash in your account, it's fine. And cash is very different than, say, profit in a business, right? So you could be profitable, but you don't have any cash in your bank account, right? And so that's where for us, cash flow is obviously important. We're going to be coming to that, but like reserves sitting there just in case something comes up, that you didn't expect, or you have, vacancy starts to creep up, or we do a lot of due diligence ahead of time where we do a really good job at being able to project out what things could come up and make sure that they're budgeted for. But the reality is the way that you kill a deal real quick is by running out of cash. The way you demolish businesses die because they ran out of cash. Ultimately, if they would have had more cash, they could have kept running. And so that rule is something that we'll just say makes it's extra insurance. It's another step in the insurance game there, is just in case you can kind of live to see another day.
That's right. sudden repairs do come up, right? We do a very extensive due diligence process. In fact, we've covered, it took 2 episodes, right, to cover our due diligence process. In a sense, that's how extensive it is. But things do happen, right, that you can't always predict. Obviously, in certain markets, we even have weather concern, whether that's hurricanes or whatever. Now, we get very good insurance to mitigate most of that, but sometimes, you just never know when something could happen. And, a bunch of HVAC systems go out at the same time, and you don't have those cash reserves in place, then all of a sudden cash flow is impacted for our investors. So it's all about that rainy day. And to your point, cash is oxygen. So when we underwrite a deals, that's the first thing that goes in, and we never touch it. It's always there. And if the deal doesn't support with those reserves in place, we don't get funny and go, well, maybe we only need 3 months. It's 6 months. It's 10%. It's a golden rule. We do not deviate from that rule.
Yeah, well said. The next rule is we buy properties that cash flow from day one. So cash flowing properties, you've probably heard Robert Kiyosaki. And if you haven't read the book, there's a couple books that Robert Kiyosaki wrote. And so Rich Dad, Poor Dad is one, and then Cash Flow Quadrant is another. But I mean, Robert Kiyosaki's huge. He says cash flow, buy for cash flow, cash flow. It's like, and when you go through a tough market, you realize the wisdom on what he's talking about.
Hmm.
Because again, if you're buying a personal property and you're having to feed the deal, as in the income doesn't cover all of the expenses, and you feed it $100, $200, that's one thing.
Right.
Okay. But when you're buying these 10, 20, $30 million deals and there's no money coming in, it eats 3 meals a day. Like you
Hmm.
got to keep the money's got to come from somewhere. And so if you get your timelines off and that property isn't carrying, the problem there is now you're eating into your reserves, right? But if the property cash flows from day one, then it's like we'll just think of it as a child that grows up that can pay for themselves,
Hmm.
right? There are a
Hmm.
lot of kids living at home right now, and they're having to, the parents are basically fueling them. The parents are they're paying for all their their food and their stay and whatnot. But as soon as the kid goes out on their own, they're looking after themselves, and it's such a relief, right? It's moving on, even if something takes longer to say execute in regards to like a renovation plan or whatnot. It's okay. The property is still carrying itself.
That's right. Yeah. I mean, to me, a deal that doesn't cash flow and you invest in that deal, you're doing it's speculation, right? It's almost like gambling. And, that's okay for some. Some people have higher risk tolerance. For us, we invest personally alongside our limited partner investors. So I think that's important to note. But we take it very seriously. Folks trust us with their hard earned money, and we take that responsibility like deathly serious. And so we're never going to gamble with their money. And a deal that doesn't cash flow, it's pure speculation. And so when you have a deal that's already cash flowing, it allows you to come in, do your capex plan, but income's already coming in. So, for example, our investors are getting distributions typically starting in the first 3 to 6 months. But the reality is that first 3 months, we just have to get the accounting set up, all the, everything processed and transferred over. And so that first distribution goes out. It's actually a catch up back to day one. So our investors are seeing cash flow effectively immediately when they invest with us and we close on that transaction. So it's a benefit to them. It's return of capital. So it's taxed at a different rate. It allows them to get some cash flow coming in if maybe they're in a place in their life where they either A, rely on that cash flow, or B, just like to have it. But it's removing some of that risk because ultimately we've got a proven deal. It's just now we have to, add our value add plan, our 28-day transformation, and slowly increase that income over time to deliver those exceptional returns at an exit.
When you say capex, so it's
Yeah,
like capital expenditures or like the renovation budget.
that's right.
But in regards to we'll talk about this cash flow right now. So that 5%, the return of capital, John. I just want to like build on what you said because the return of capital side of it is massive. So any other investment, when you're getting your returns in, you're paying tax on that. But
Hmm.
because how we structure a deal, that if it's 5 or 6% cash flow that's coming in, cash on cash returns, because of how we structure it, as in that the returns are going back to our investors. So it's like you invest, but then because it's return of capital, you're not having to pay tax on that. You're able to keep that 5 to 6% in your pocket until we sell the property, and then there's some recapture and it's based on capital gains on the full amount. but not paying tax on that along the way just means that your overall net returns while we're holding the project is a lot more. So 5 to 6% could be as strong as a 7, 8, 9% return if you're getting tax, right? So you're keeping the same amount of money in your pocket. So that is a major, we'll say, positive thing that I just wanted to build on what you said there to give context for the listeners.
No, it's huge. Just kind of sum up the component there with cash flow. If a deal only works under perfect conditions, it's not a good deal, right? It's a gamble, and I think that's how you have to think about it. So these are rules you can apply as an investor. Maybe you're buying single family rentals or investing in another sort of commercial asset class. These rules apply across any real estate investment. So if you're out there investing on your own as an individual, think about these rules and go look at your portfolio and maybe look at the deals you maybe did take a little bit of gamble on, and analyze them and see how they worked out. And I guarantee you'll find the ones that these rules were followed on will be your best deals every single time.
For sure. And John, so we'll just say from a real estate investing backyard standpoint, you're in, I would argue, a better market than say where I was from. So in Ontario, for example, just north of Toronto, properties used to cash flow in my backyard, right? We'd have investors through the years. On the brokerage side, we would help them find a property, would cash flow. And plus they would get appreciation, natural appreciation with upside. Well, what happened was eventually properties didn't cash flow in that market anymore. And there's a lot of markets in around North America that just will not cash flow. You're like, okay, those rules are all, fine and dandy there, Mark and John, but my backyard, they just don't cash flow anymore. And so you might need to do what I did. I had to actually start investing in, for me, it was a new country. So from Canada to the US, but it might be a different state. And so that's where John, like being in Atlanta, I mean, that's one of our premium markets we love. The properties cash flow from day one.
That's right. Yeah, it's a great market. Relative low cost of living compared to other markets in the U.S. It's amazing though. Post pandemic, our home values went up like 40%, and so it has shifted quite a bit. But still a market where deals cash flow, landlord friendly, and it's a market we love. Central Florida, the Carolinas. These are all markets that we keep a close eye on just for all those reasons. Cash flowing real estate deals and strong economic drivers. So it's that idea. Obviously you should invest where but sometimes you just don't have that benefit. And so that's where working with companies like Faris Capital Partners can give you that advantage, because it allows you to invest, say, in another country if you're in Canada, but without all the having to get on a plane and come fly down. And another thing, Mark, is this isn't really what this podcast is about, but we've done it in a tax efficient way, so our Canadian investors aren't subjected to dual taxation on both sides of the border. So that's something, as an individual, you have to be very cautious, because let's just say you're up in Ontario and you decide, I'm going to buy some rental property down in Detroit. If you don't do it the right way, your gains will be eaten up by the US and Canadian tax authorities, right? And so that is not something you want to go too quick on. So even if you're just an investor and you're thinking about doing it yourself, reach out to us. Even if you're not
Yeah.
wanting to invest in us, we'd be happy to help you with some resources and some guidance around that, because it is a critical step. If you get that wrong, your returns could just be demolished.
Yeah, for sure. And so, yeah, buying, hoping the market's going to go up is, to me, over the years, long term, I've seen that works sometimes. And when you're in a rising market, it can be, beautiful returns, like just
Mhm.
phenomenal. But in the long term, you want to make sure that you are buying for cash flow and appreciation. That's where, John, when I get the questions like, what do you like, cash flow or appreciation? I say, I like both.
Yeah,
I
yeah.
want both. And I want downside protection. And I want landlord friendly. And I want tax efficient. And I want a good operator. So it's like all these,
Yeah.
all these things add up, but it's because you start to see, oh, that happened with that operator. And oh, that deal went sideways because of this. And it's like, you want to be able to button up all those, like, what if
Yeah.
happen. And so the beauty with these three rules is it's just super consistent. You're no matter what happens in the market, when it comes down to interest rates, your payment's going to stay the same,
Yeah.
right? And so that the beauty with that is you'll do well over time. And then when you stack on the value add approach that we do, we force that. That is something you can control. We force the appreciation by doing strategic renovations and increasing overall income in the building by getting rent premiums on renovated units. And so if you stack all these rules together, but starting with the big three that we just shared
Yeah.
with you, it can be just the most amount of upside with the least amount of downside. So it would basically make Warren Buffett pretty happy.
Yeah, that's right. You made a great point. We have other rules, right? One is we want to see a decent amount of loss to lease. In other words, what are the in-place rents and what are the market rents? And we want to see a certain amount of upside already there. So it's not just these three things, but before we even underwrite a deal, we have to ensure that these three boxes get checked before we even take that next step. And so just goes back to, if you're an investor, heck, if you're just a business person, look at your business and make some decisions. What are the rules that we just do not compromise on? It could be how you negotiate or how you manage your team, but create those rules and talk about them a lot with your team. We talk about these rules every day. I mean, quite literally, whenever we're looking at a deal, we're talking about these rules, and it's just ingrained within the team. And so it just eliminates decision making, right? It just makes it easier to focus on those deals and opportunities that have that higher opportunity of working versus wasting time on some stuff that, at the end of the day is just going to be a loser.
Yeah, well said, John. So, hope this was helpful, guys. Just a quick summary of what the three rules are. So, number one, fixed debt, or if it's variable rate or adjustable rate mortgage, you want to make sure to buy a rate cap on that. Number two is adequate cash reserves. That's really important. If you lose cash, you lose your oxygen.
That's right. That's
Right.
right.
So cash is king and cash is oxygen. So make sure you have enough of it up front. And the last one is to ensure that you're buying properties for cash flow, because at the end of the day, if something goes sideways, the property can carry itself and you're not having to dip in your own wallet to make sure that the property can continue to operate and move forward. All right. Thanks for listening, guys. If you enjoyed the show, please subscribe and share with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.